Hey, this is Chris. I'm the founder and CEO of StockSpot, which is an Aussie fintech growth business. And this video is on a slightly different tangent to the usual videos I do about investing. It's about employee share options and employee shares. And it's a question I've had to talk to a lot of employees about, and I'm quite familiar with, because even before this job, in my previous job, I was the recipient of employee shares, and here as the founder of the business, I've been the creator of our employee share scheme. And so I often get asked a lot of questions about share schemes, and if I was on the other side, there's a lot of questions I would now ask about employee share schemes. So in this video, I'm going to share the questions I think you should be asking if you're lucky enough to work for a company where you're offered shares or options in the business, because these are the questions that will help you determine whether they're valuable, how valuable they are, and whether you're likely to get a good return from them in the future. Because broadly, I think share options and shares within a company's compensation or pay are an awesome thing. It makes you a part owner in a business. It gives you the opportunity to share in the profits and the growth over time. However, there are risks, and there are big differences in how these plans are structured that really determine how valuable they're likely to be in the future. And for every story you hear about someone that started at Google or Facebook and earned great employee shares, unfortunately, there's also sad stories of people who were promised shares or earned shares that ultimately weren't worth anything. So these questions will help you risk assess, whether the options or shares that you've been offered are actually, worth what you've been told. So the first question I would say is a very simple one: are they shares or options? So there's big differences between these two. A share is actually a part ownership in a company. It gives you rights to participate in dividends, for instance, and sharing in profits. An option is less valuable than a share. An option gives you the right to buy a share at a point in time or between now and a point in time in the future, but you usually have to pay an amount to be able to exercise that right, which is known as the strike price. So as an option holder, you only really benefit in the growth of the company above a certain value, whereas a shareholder, you usually participate in the overall value of the company today and any growth in the future. So, like for like options are generally less valuable than shares. However, they can still be valuable, particularly if the strike price is fair. It's not too far above what the current share value is. And so you've actually got a good shot at actually achieving some value above today's share price. There are also some nuances around share plans. You can have a loan-funded share plan where the company loans you money to buy the shares. This is a bit more similar to an option plan because you actually have to pay an amount to access them in the future. And so it's a good question to ask if it's a share plan is, do I have to fund the shares in the future, or am I given a loan to fund them by the company, or am I just given the shares? And that will sort of lead to quite big differences in how much they're worth. So that's the first question, shares or options. The second question is, how much are they worth today? So, a good question to ask to get a sense of, what the value of the shares you've been offered are is, how much is the company worth? How many shares are there? And therefore, how much are my shares worth? And how much confidence do you have around that? So if it's a listed company, you can usually see what the share price is every day and you get a good sense of how much they're worth. If they're unlisted, it's a little bit harder. You have to rely on, past data about capital raisings, transactions between shareholders. There are sometimes, strong data points that show what a company's worth. There are also less strong data points around what a company's worth. And so getting a sense of how confident the company is in how much they think they're worth, will help you assess how much your shares in the company are worth. I think I see a lot of people online discussing, that the percentage of the company is important. I don't think that's as important as really just understanding, how confident the company is in the overall valuation. I think having a smaller percentage of something that's more valuable is obviously going to be better in the long run than a bigger percentage of something that's worthless. So, the overall company value is more important probably than how much of the percentage of the company you own, which brings me to the sort of other side of that, which is that you need to be asking, where do I sit in terms of getting my money out of the company? So typically venture funded businesses have lots of tiers of shares. You might hear them as, ordinary, preference, Series A, B, Series C, Series D. Generally as an employee, you're last out when it comes to getting your money out of the company. So it's good to understand where your shares sit versus everyone else's and how many people sit in front of you. So if a company's already raised $50 million of outside capital, the chances are that there's $50 million worth of people already sitting in front of you to get their money out. And so you need to think about whether you think that company can be worth more than $50 million, because if it isn't, you're probably not going to participate very much. So as an employee, you generally want there to be less shares issues and less money raised by a company, because it gives you a bigger proportion of that company as they grow. Now, obviously, if a company can be quite capital efficient and use money that they've raised to grow very fast, that's great. But I think something that we're going to see more and more over the next few years is companies that have raised a lot of money, but their valuations haven't really increased too much beyond the amount that they've raised, which unfortunately won't leave a lot for employees to share in the end. So that's another question. The next question I would ask is, what are the drivers of value in this business? What will lead to the share price increasing? Really understanding the fundamentals of the business and what's going to drive business growth is important. And then what is that sort of realization process? So how will you actually get money out of those shares? If they're already listed on the share market, it's pretty easy to see that once you earn those shares, or they vest, which is when the process of you earning those shares, you'll be able to sell them. But understanding from the business owners or the founder what their plans are for extracting value or helping you realize value from your shares is important. Will the company one day IPO? Is that the plan? Will there be a strategic buyer? Is the company planning to have a grey market where existing shareholders or other employees can buy other people's shares? And that will also give you some idea of the timing of when you might be able to get money out, because there's certainly companies where you can get money out as an employee more regularly, particularly listed companies. You might earn some of your shares each year and there might be a window to sell those shares. But there's other companies where it might take reasonably 5 to 10 years to get any value out. And that may be a good thing or might be a bad thing. I think it's a great thing because it will force you to hold on to those shares and it will give you the benefit of a lot of growth if the company grows well. But if you need money in the next year to pay for a mortgage or something like this, it's good to know that whether you're going to be able to get some of that share money out in that sort of time frame that you need as well. So the timing and the plan to actually realize value is another question I'd be asking. That also sort of feeds into the liquidity question. How liquid are the shares? This is how easily realizable they are. Again, not having liquidity isn't a bad thing. There are lots of great companies that have not listed for a long time, and actually, it's actually been a lucky thing for employees not to be able to sell as the company's grown, because then when they can sell, it's such an amazing windfall, and they might have actually sold too early if they had the opportunity. But understanding the liquidity and when you can get money out is another question I'd be asking. Last couple of questions, what do I need to do to keep the shares? So a lot of companies will have what's called a vesting schedule, which is basically the process of you earning those shares over a period of years. It might be 3 years or 4 years or 5 years is quite common. There's often a cliff, which means that if you leave before a certain amount of time, you don't earn any shares, or there may be other reasons why you might not own those shares even if you do leave after a cliff as well. So asking all of these sorts of questions is important. The last two would be, what am I giving up to get these shares? Nothing's free, and so understanding, what am I giving up? Am I earning a lower salary, or is this on top of a salary, or what's the quid pro quo for these shares is another question. And a lot of startups these days are using shares as a way of attracting people even on top of salary. So it may not be that you're giving up much at all. And it might give you a lot of upside, but generally if you're not giving up a lot, you may not be getting as much value. So, really if a company is giving you very good quality shares in a company, it's likely that you might need to sacrifice something else in order to get that upside in the business. And then the final question I'd be asking is, what is the tax considerations? So this is something I don't think a lot of people focus on. But it's really important because when you do eventually realize those shares one day, you're probably going to need to pay tax. So is that tax going to be paid on the income account, or is it going to be paid on the capital account? So have you bought these shares, which would lead to a capital gains one day? And there's tax rules in Australia that are quite beneficial from a capital gains perspective. Or will you realize a big income on that year, which probably isn't going to be a good thing, because if you suddenly sell all your shares one day when the company IPOs, it might push you into a higher marginal tax bracket and you might have to pay more tax. But thinking ahead around the tax side of your shares is also, I think, a useful question, in the event that the company is successful and you actually get something out one day. So that would be a very quick summary of the questions I'd be asking any business. If you're considering joining a company where there's shares on offer, I'd love to hear any other questions you have. So if you have any other questions, please add them to the comment section below. I hope it helps you guys make better decisions when it comes to picking companies that offer shares and options as part of their compensation.